Hello there traders, my name is Elizaveta Belugina and very welcome to our today's webinar on Forex market on the outlook of the major currencies for this week. So let us see the presentation. Here it is, and our usual agenda: the market's positioning, economic calendar, technical analysis and tips, and trade ideas. First of all, let's talk about the CFTC data, commitments of traders. I find this piece of data extremely valuable, although this data have a time lag. The data have been released on Friday, and they cover the week which ended on Tuesday, March 14th. But still, we can try to catch some important changes in positioning of large players, and this should help us detect some changes in big market trends. So as we may see, the overall US dollar long position, net long position, once again increased during the week we are talking about, and the size of the US long has reached the highest level since the beginning of February. If we look at other currencies, we can see that the largest net short position is on the British pound, and this net short on pound keeps increasing. Actually, it has been rising for 6 weeks in a row, and during the week we are reviewing, there was a sizable increase of this short position on the British pound. We can see that the size of the short position on the single currency, the euro, is also rather big, but here we have the opposite dynamics of this position. The market players are reducing their negative bets on the euro. So here we have this bearish trend reversing. And Japanese yen also has a big net bearish position, and like British pound, here we see the increase in this bearish position during the week we are reviewing. As for commodity currencies like Canadian and Australian dollars, they have net long position, but the weekly change shows us that this net long position decreased, and the overall bullish net position is not very big on Canadian and Australian dollar. So it may be that some big reversal is taking place for these currencies. So what we can see that surely the divergence in trend between the US dollar and other major currencies still exists, despite some pullback in the US currency, which took place last week after the Federal Reserve's meeting. All in all, this divergence between the US and other nations is keeping some long-term trends for the US dollar still in place. If we look at the weekly chart of the US dollar, however, we can see that there was a decline in the American currency. It fell below the level of 100 points, and the currency is vulnerable for further declines to the level of 99.25. This is the next Fibonacci level, and the minimum of the previous of this year of 2017. So the odds are that we'll see the US currency test this level in the US dollar index, the area between 99.25 and 99. If we see the decline below this point, then it will probably open the way down to 98 level for the US dollar index. Resistance for the currency is located at 101 mark. This is the previous Fibonacci level, 23.6% Fibonacci retracement of the dollar's advance from March 2016 to the end of 2016, beginning of 2017, and also 101.50 is the last resistance level, which should keep the US dollar under pressure in the coming days. Here are the technical targets for the US dollar, and of course the past week was very eventful for the American currency. The major event was surely the meeting of the US Federal Reserve. The Fed, as you probably know, raised the key interest rate by 25 basis points as expected. So this wasn't a surprise for the market, and this rate hike was completely priced in by the market. As a result, we saw this decline in the US dollar after the meeting. The famous statement, buy on rumor, sell on fact. Actually, we saw how it worked for the US dollar, and we saw that the rate hike is not always leading to the appreciation idea. This is an idea to, and it helps us understand that the market sentiment, the market's positioning is probably even more important at Forex market than the actual events which take place. The Federal Reserve also signaled a gradual approach for rate tightening, with only 2 more rate hikes this year, and this was another reason why this decline in the US currency persisted. Some traders and many analysts were positioning for higher dollar. They were preparing for a more hawkish statement of the Federal Reserve. They thought that some fiscal easing, fiscal stimulus, which is planned by Donald Trump next year, will make the Federal Reserve move faster with the rate hikes. But actually, the chair of the Federal Reserve, Janet Yellen, said nothing about a rate hike in June. She said that one more rate hike, one less rate hike in 2017. It really doesn't matter. The Fed's approach will be gradual to the rate hikes, and that the US Central Bank will surely monitor the economic situation. So you can see how the statement was not the hawkish statement the market players have expected. We'll hear more from the Federal Reserve in the coming days. The FOMC member Evans will speak on Monday. Dudley will speak on Tuesday. Yellen and Kashkari on Thursday, and Kaplan and Evans on Friday. Actually, Kashkari has already said that he voted to leave the interest rate unchanged. He dissented from the majority of FOMC members who voted for a rate hike in March, and Kashkari explained his position, saying that he thinks that the US economic growth is a bit worse than the Federal Reserve wants to see it, and that inflation in the United States isn't too high as well. So this is why he thinks that it is too early to increase interest rates. Other members of the FOMC will surely bring volatility to the Forex market this week. Attention to these speeches will be high, as traders are really eager to know more about the plans of the US Central Bank and to hear other members of FOMC besides Janet Yellen in order to see whether the Fed tries to prepare the market for some more hawkish steps in the near future, or that the central bank remains in the wait-and-see mode for some more months in order to see the incoming data and to make a new judgment about the rate hikes. I think that the speeches of the FOMC officials, which I have mentioned, will likely provide some support for the US dollar, and this is why, looking at this chart of the US dollar index, I think that the bears will have a significant obstacle in the area of 99.25, 99. Still, it is likely that the Federal Reserve will want to wait for some more data releases, and my overall opinion is that for some time, maybe for some days, but more likely for some weeks, the US currency will show some negative dynamics. If you look at the data by Chicago Mercantile Exchange, here is how the market is pricing in the possibility of the US rate hike in June. We can see that this possibility currently accounts for more than 58%. On Friday, the possibility was around 54%, and surely there is some increase. But all in all, we can't say that this possibility is really high. Still, the market has room for pricing in higher rate hikes, but to do that, we'll need some economic evidence, some stronger data releases from the US, or more hawkish comments from the Federal Reserve. In the medium term, of course, I think that the Fed's policy tightening and the expectations of fiscal stimulus from Donald Trump should reignite demand for the American currency. And I think that surely there will be many players who would like to buy the US dollar on its pullback to the downside. So, of course, trading will depend on what currency are you trading versus the US dollar. In general, for the US dollar index, I have mentioned my targets. I have mentioned support levels we have and resistance levels we have. I'm in favor of selling the US dollar index at the current levels with conservative targets, or maybe looking for opportunities to sell on recoveries to resistance in the area of 101, 150. As for long positions, I think that in the current circumstances, if we take the US dollar index separately, they seem too risky. But maybe in a week from now, when we'll get more data releases from the Fed and comments from the Fed, then maybe we'll have more of the evidence on whether this trend, the uptrend in the US dollar, will get resumed, or if we'll have a deeper retracement in the American currency to the downside. But if we have to look at the American economic calendar, then Fed speakers probably will be the major highlights of the week, as the data releases in America are not these important, those which are planned for the next days. Let's discuss the picture for other currencies and dynamics of these currencies versus the US dollar. As usual, we start with euro dollar and we start with weekly chart. And I think at the weekly chart, it is fairly clear that the euro is in a rather in a rather good position these days. We can see that the key level, which is located at 105, I remember that we had discussed this level before, and I mentioned that this level provides strong support. We can see that in the last week, euro dollar dipped to the downside, but it even didn't reach this 105 level. The buyers returned to the market, and we have a series of quite similar weekly candles here for the euro dollar. The candles with a long lower shadow and 3 bullish candles, which showed that if we judge by the result of the week, the bulls managed to become winners of the situation. The fact that the pair did go lower before it went higher surely means that the bears don't completely give up for the euro dollar, but the bulls are ultimately stronger. So if we analyze the events on the past week, we may see that the pair initially went down to test 106 mark, but this round level, this big figure, provided support. Also, support was provided by the bottom of the daily bullish Ishimoku cloud, and then there was an increase. The pair surged and approached 108 mark. The euro had several sources of strength. Firstly, the pair surged on the weaker US dollar after the Federal Reserve meeting. We have discussed already that. Secondly, there was talk that the European Central Bank would raise interest rate before ending its quantitative easing program. This talk of higher rates in Europe is a rather strong bullish driver for the European currency, as it is combined with high inflation figures, which we now see for the region. And well, we can remember that for a long time we were talking about lower rates, more stimulus in Europe, and now we can see how this trend is starting to change. I think that after the political risks are off the table, after the French presidential election in April and May, we will likely see the market pricing in more hawkish approach of the European Central Bank and the tapering of the ECB's quantitative easing, and this will be bullish for the euro. In addition, the third driver of the bulls here was that the Dutch election brought some favorable results. A pro-European coalition will rule the Netherlands after the election, and the risk that the populist parties will trigger the referendum on the Netherlands leaving the euro area and the European Union has now been eliminated. This surely creates a more favorable setup for the French election, where we have the similar source of fear of the market that a far-right movement will win and pull the nation out of the euro area. Surely Netherlands, with their high turnout at the voting places, made the situation better and increased their optimism about the future of the euro area. So these were the sources of bullish movement in the euro dollar. However, terrorist attacks in France kept gains in the single currency, and in addition, the French presidential election scheduled on April 23rd will still limit demand for the euro, despite the fact that concerns have decreased. Still, the main counterparts, Emmanuel Macron and Marine Le Pen, are really close in opinion polls. The situation may change and some risks remain, and key strategic investors, key large players may still be wary of holding the euro in the medium term. This is why demand is limited. We are watching CFTC data. We can see that the short positions on the euro are declining, but still it is too early to call this a big change in trend for the single currency. So stay cautious and note that above 107.70, our main targets on the upside are 108 and probably 108.30. These are conservative targets, and for now, I think that it will be enough to bet for the euros advance to these levels and not higher. If we take a closer look at the technical chart, we can see that on the daily chart, we are supported by the Shimon cloud, as I have already said. Also, this brown line of the 50-day moving average is about to cross the 100-day moving average to the upside. At the same time, the pair has surely become overbought, and it became overbought near significant resistance of 108. Here we find the resistance line, which actually started at the end of last year. We can draw this line something like this. Let me make it more visible and see more clearly. So this is the resistance line I'm talking about, and it is situated in the area of 108. So this is a resistance. The pair is overbought, and this combination presents a reason to expect some consolidation and maybe some correction of the currency pair. This line should represent significant obstacle for the bulls. If the pair managed to close, to show a daily close above 108.50, then it will be surely a strong message that the pair is ready to test some higher levels. Probably better see here. These levels will be around 109.10, 109.70. Here it is. Also, I'd like to point out that if we are looking at the weekly chart, you can also use moving averages, and the 50-week moving average is currently located in the area of 109.60. So it will be the obstacles for the price, but the movement above 108.50, here is this level, will kind of show that the price broke above 2017 highs, and this will be a kind of double bottom formation. So we'll likely see this push to the upside, and the initial targets I have mentioned, 109.10, 109.70. But once again, I'll repeat that for my trades, I have some more conservative targets on the upside around 108, 108.30, and only above 108.50 will I open some position targeting these higher levels for the euro dollar. Otherwise, if we don't see this attack, if the pair goes for consolidation, then we will be looking for retracements towards 107, mark 106.80, 106.40. Here are the moving averages, and 106 mark, where we have this bottom of the daily Ishimoku cloud. Important events in the European economic calendar include the speech of German Bundesbank President on Monday, ECB economic bulletin on Thursday, and the region's flash manufacturing and services PMI indexes on Friday. So these are the things to watch for the single currency. I think that if the pair drifts down in consolidation, then levels around 106, 106.50 should represent some buying opportunities of the single currency. Also, I use this indicator I already told you about. It is called pivot points multi-time frame. It is reset every week, and it shows us the weekly levels, the weekly pivot levels for the European currency, and any currency pair you apply this indicator to. For the European currency, it shows us that the weekly pivot is located at 107.07, and above this mark, the weekly outlook for the single currency versus the US dollar will be bullish. The resistance levels, the targets lie at 108.14, 108.90, and 110 approximately. So we don't target usually the third resistance or third support, but the first one, the second one seem to be quite attainable according to this weekly pivot levels, while support is at 106.30 and 105.20. So you can actually use different approaches to determine support and resistance levels on Forex. You can trace the levels of previous highs and lows. You can do some visual analysis. You can use indicators like the moving averages and indicators like pivot points levels. I find that this weekly indicator works pretty well. So for now, above 107 mark, we are short-term bullish on the euro and looking for the buying opportunities, even if the pair retraces a bit lower to the downside levels. As for the British pound, here we are. The pair has managed to show some advance during the past week. Here the reasons of higher GBPUSD were pretty the same, partially as the reasons of high euro versus the US dollar, as firstly there was the broad weakness of the US currency, and secondly there were some news connected with the central bank, which turned out to be positive for the currency. The Bank of England left interest rate on hold, but its member Christine Forbes voted for a rate hike and thereby showed that policymakers are becoming more and more concerned with a rise in inflation. Her vote surprised the market and made the pound rise. So this is why we saw GBPUSD test these resistance levels. On the political front, the UK Prime Minister Theresa May has finally received a formal permission to trigger Article 50 by the end of March. And the fresh data is that, according to her spokesperson, this Article 50 will be triggered on March 29th. Of course, I think that we'll see the weaker pound on this triggering of Article 50. Despite the fact that much has been priced in already in the British pound, still such an unprecedented event as the start of the nation's formal exit from the euro area, from the European Union, will likely draw some sellers to the pound. If we look at the daily chart, we can see that this may be especially true as we can see that the pound has met resistance in form of resistance line, which connects February highs. And also here are some levels of resistance in form of 100-day and 50-day moving averages. This resistance is located just above 1.24 mark, and as long as GBP is trading below this resistance, then the odds are that we'll see the currency revisit support at 1.23 level, or probably even at 1.22 mark. This week, I advise you to keep an eye on the British inflation figures and retail sales coming on Tuesday and Thursday respectively. We'll also watch comments from the FOMC members in the United States. This is the fundamental part of things. Technically, the indicators point at some retracement in the British pound. I have already mentioned the levels of support. If you look at the 4-hour chart, we can see that here are some changes in the moving averages. The pair has managed to overcome these averages in the past week, and as a result, the retracement towards 1.23 will likely draw some buyers, and the pressure of the pound to get above 1.24 may intensify. All in all, despite the approaching Brexit, the UK economy is doing more or less good, and everyone understands that Brexit will be a long process, so we don't think that it will be a big negative factor for the US, for the British pound in the coming months and in the coming weeks. Some negative reaction is possible. We have heard that there is a date now. The date is May 29, but of course nothing may really change at this date, and this downside potential for the British currency should remain limited given the overall weakness of the US dollar, given a more hawkish approach from the Bank of England. So look for levels around 1.23 to make some small longs, and also look for the pair to break above resistance to have further targets. Here I also have this weekly pivot indicator, and it gives us the targets at 1.2495 and 1.2597 as the upward targets. GBPUSD here, and it was GBPUSD. Now we are having a look at dollar yen. We are looking at the daily chart of the pair. Which chart is better? Well, I think I use this one. The pair was under pressure of the bearish Ishimoku cloud. It also managed to break two moving averages, the 50-day moving average and 100-day moving average. A close below 100-day moving average was seen, and the pair is now holding at support of 112.50. But I think that this week we are vulnerable for a bigger decline, and the target of this decline lies at the level of 111.50. This is the Fibonacci level, and this also is the level of February minimums. All in all, there was a meeting of the Bank of Japan. Last week, the regulator left interest rates unchanged and expressed concerns about low inflation. Governor Kuroda noted that there is still distance to the 2% inflation target, and to achieve it as soon as possible, it is appropriate to continue the powerful easing under the current framework. As a result, it's clear that the Bank of Japan aims to continue extremely accommodative monetary policy in future. And of course, such policy contrasts with the policy of the Federal Reserve, the tightening of the Federal Reserve. That's why the greenbacks pullback to the downside should be temporary. Still, despite this factor, I think that in the near term, more downside seems quite possible. We should remember that March is a time when Japanese investors are preparing for the end of the fiscal year, and usually there is a high repatriation of funds from abroad to Japan. This is a factor which contributes to higher demand for the Japanese yen, and despite the fact that the Bank of Japan keeps its monetary policy loose, this factor in the short term may lead to dollar-yen testing levels near 111.50. So we can see here in the daily chart that there is significant resistance of the former support at 113.50. Here we have the Ishimoku cloud and the 50-day moving average, as well as the previous lows of the start of March. And I think that this cloud, this line, this resistance will keep the pair under pressure. And below this resistance, we'll target to 111.50 mark. And probably we should talk a bit about some commodity currencies. Let's have a look on Australian dollar, US dollar. Of course, the weakness of the US dollar led to the appreciation of Australian dollar and other commodity currencies versus the greenback as well. The pair Australian dollar, US dollar has reached February highs in the area of 0.7750, but we can see that this is the area of long-term resistance for the pair. And despite this strong weekly movement of the pair, still we really doubt that the pair is able to overcome this strong resistance. At least the initial reaction can be to the downside here. Australia has shown some weak labor data, so this is why I don't recommend currently any long positions. Support is located at 0.7610, so this is the level we can expect some buying positions. And all in all, I think that in the coming days here, we'll see some consolidation in Australian dollar, US dollar. Let's have a look at the New Zealand dollar as well. Here, the pair also managed to recover, and it almost approached resistance from February highs, and resistance above the current price is formed by the almost horizontal moving averages located in the area of 0.7110, 0.7150. New Zealand's annual growth rate slowed further despite surging immigration, low borrowing costs, and evident activity in the housing sector. This casts doubt on the latest central bank's projection that growth would accelerate to more than 4% by the second half of 2017. And this is what limits the ability of the New Zealand dollar to strengthen. The main focus of the current week will be the meeting of the Reserve Bank of New Zealand on Thursday. The consensus forecast is that the benchmark interest rate will be left on hold at 1.27 mark. And many analysts expect the central bank to adopt a wait-and-see approach. Ahead of the meeting, we'll get an update of global dairy prices, and also comments and news from the United States will be also important. But taking into account the fact that the pair has already appreciated on the weaker dollar and that we have approached these resistance levels, once again, here I don't think that long positions is what you want to engage in these days in these pairs. Also remember that there was a reduction in the long positions for Australian dollar, Canadian dollar. New Zealand dollar is also vulnerable for that. So here I currently don't see enough reasons to open long positions despite some weakness in the US dollar. Also important thing to remember that risk aversion is also contributing to the dynamics of these currencies which have high interest rates, and these currencies which are closely involved in global trade. And during the weekend, there was the meeting of G20 finance ministers and central bankers, and this meeting failed to produce a statement from these G20 nations on fighting trade protectionism. On the other hand, the policy of the US President Donald Trump is in favor of protecting American trade and trying to decrease the US trade deficit. As a result of this, concerns about global trade and relations between the US and China and other economies are hurting global trade and risk sentiment, and commodity currencies in that sense are vulnerable. Although, given the fact that there was a decline in crude oil prices, we can see how Canadian dollar has been losing versus the US dollar these days. For US dollar, Canadian dollar found support at 100-day moving average in the area of 1.33, and above this level the pair can show some consolidation between here and 1.35 mark, as the oil prices is declining on the increased output from the United States, and this may be the case of oil dynamics this week. Oil is an important export of Canada. This is why Canadian dollar is affected by decline in oil prices. So here we may see some stabilization. And if we look at the price of gold, it has managed to strengthen after the Fed's meeting, and there is, despite the fact that the asset got overbought, some further attempts to get to 1240, maybe a bit higher, are possible in the past week, this week. Although we can see how the movement of gold is getting less rapid as political concerns in Europe are declining, and gold has become overbought. This may make the asset slow down its appreciation. If we are talking about French election, by the way, today will be the first debate between the candidates, Marine Le Pen, Emmanuel Macron, and it will be interesting to know whether the results of opinion polls change after this debate and how the candidates manage to present themselves. I think it will be important as well, and tomorrow we'll hear a lot about this. So now let's try to make some conclusions of what we have discussed today. The conclusions are the following: that the US dollar will likely remain under pressure. In the US dollar index, there is potential for moderate decline to the levels of 99.25, 99 marks. If we are talking about the euro dollar, it is slightly overbought, and decline towards 107, 106.50 may represent buying opportunities with targets around 108, 108.30. For the British pound, we have approached resistance around 1.24. Pullbacks down to 1.23 may find demand, but we need a solid close above 1.2320 to test levels around 1.25. For dollar yen, the pair is vulnerable for decline to 111.50 as long as it stays below resistance at 113.50. And commodity currencies have made significant increases during the past week, and we don't think that buying these commodity currencies represent a good idea right now for various reasons. This is what I wanted to share with you today. I hope that my information was valuable and it will help you in your trades. Thank you for your attention. I remind you that my name is Elizaveta Belugina and I'm head of analytical department at FBS. I wish you good luck in your trades and we'll be happy to meet you next week on our weekly Forex webinar. Goodbye.